This is Basket Case Clubs, CPR Group's podcast where we turn basket case clubs into showcase clubs.
G'day and welcome to those of you who are online already. Welcome to the final webinar for 2025 in our free CPR Group webinar series. It's great to see some familiar names on the list already and some newbies as well who are joining us for the first time. So it's nice to have a bit of a mix there of some newcomers and some usual suspects. We've had some really good attendance this year at our webinars in our free series. So as always, today's session is being recorded and will be made available to everyone who registered. So if you get some value from today's session, which hopefully you will, spending your lunch break with me today, you can share the recording with anyone else from your organisation who might not be able to make it. So it's now midday, so let's get started. Midday Queensland time, that is Australian Eastern Standard Time, not daylight time, because we here in Queensland don't want our curtains to fade, nor the dairy cows to get confused about what time of day it is. I'm not going to continue to go on about the lack of daylight savings here in Queensland, but looks like there's a couple of notes coming in the chat there. Feel free to introduce yourself. G'day Margaret, thanks for joining us. Lovely to see you online once again, and if anyone would like to say a quick g'day in the chat, feel free to do so. Let us know your name and maybe the organisation that you're representing, and there'll be at least one opportunity for you to pop a response to a question that I've got in the chat, which we'll do very, very shortly. But before we do that, as is our wont, I would like to formally acknowledge the traditional custodians of the land from which I joined today and share with you a quick little bit of story of my connection to country. Some of you know this story, and I was really lucky to grow up not too far from here as the crow flies, probably about 8 or 10 kilometres. Here on the Sunshine Coast, tucked in amongst the cane fields of Bly, right on the Maroochy River. Literally my parents' house backs onto the Maroochy River. I didn't realise how lucky I was to live there until I moved out, and I've been trying to swap them houses ever since. They haven't agreed yet, don't think they will. But every opportunity I got, my friends and I would be in our tinnies out on the Maroochy River. We'd be fishing, we'd be water skiing, we'd head up the river on a Friday afternoon, we'd come back on a Sunday. Mum and Dad wouldn't see us for a couple of nights and they'd know that we'd be okay. We didn't do as good a job extracting fish from the Maroochy River as the Cubby traditional custodians have for 60,000 years. Nevertheless, we did the best we could. And given that we never wore shoes, we were quite literally very well connected to country. So the first inhabitants of the Maroochy district, as I say, are the Cubby people. And for tens of thousands of years, they've not only fished the local rivers, but they've hunted the local ranges. They've extracted seafood from the beautiful Pacific Ocean off the coast of Mooloolaba. And the place names Maroochy and Maroochydore are derived from the Yagara words Murukachi, meaning red-bill black swan, and Murukachida, meaning place of the black swan. So a nice little bit of history there. So I acknowledge the long-standing connection of the Cubby people to the land on which I grew up and offer my deepest respects to elders past and present and also to emerging leaders. And I acknowledge also the people, place and spirit of all the country from which you're joining today, recognising that we're joining from, yes, here in Queensland, but all across the country and even over the ditch from New Zealand. Welcome to our New Zealand participants today. And also the traditional custodians of the land from which anyone might be watching this recording. I'd also like to acknowledge all of you for the wonderful work that you do, whether you're a volunteer, whether you're a council staff member, whether you're a staff member with a governing body, a state or national sporting organisation. We've got a good mix of participants online today, so thank you for the wonderful work that you do in your local community, state or territory, providing access to critically important services, activities, events, sports, and for the support that you provide to your constituents, whether they be people in your local council area or people who are involved in your sport. Our communities would be nothing like what they are today if it wasn't for people like all of you. I'm lucky I get to do this and call it work, and some of you do too. But I know that a lot of you are volunteers as well, so thank you for the time that you give willingly for the betterment of your community. So We're going to take a little bit of a Queensland-centric approach today. Most of our attendees who are online today are from Queensland, but I acknowledge, as I just mentioned a moment ago, that people are joining from all over the country. So I'm really excited to finish off the year with a bit of a bang, talking about key legal requirements that all of your organisations should be aware of. And to take a truly national approach here would be really difficult, especially in less than an hour. So I've taken the Queensland-centric approach, given that most of us are based here in Queensland, but I recognise you're not all in this state. Therefore, I'll be pointing out where you'll need to go and find some of the relevant legislation in your state and territory, and we'll finish off with a bit of a key takeaways chat from the key legal requirements that you've got to be aware of today at the end of our session. And you'll see that that's broadly applicable. And it's really the critical considerations in running your organisation that you need to be aware of in terms of maintaining compliance and ensuring that your organisation is, and its people are appropriately protected. And I really love this topic because it helps us, or gives us an opportunity to address some of the really common questions that we get asked at CPR Group, like, who is accountable for managing our money? Does our club have to pay income tax to the ATO with the recent law changes there? Do we have to pay GST? Do we have to keep some records when we run raffles? And of course, this question. So as I promised, I want you to pop a little note in the chat. This is your opportunity now to answer this question in the chat, and just, it can be a one-word answer. You can give me a bit more context if you wish, but I want to know your opinion on the correct answer to this question. Can a committee member go to jail for doing the wrong thing? Thank you, Paul. You get the first gold star. Lucky number one, who said yes. Anne said not sure. Trish, possibly. Claire, yes, but unlikely. This is great. We've got a really good spread of responses, and I'm so appreciative of you all getting involved. Thank you very much. It's always a really good test to make sure that someone's not just dialed in, but also cooking or cleaning or doing something else. I'm not very good at multitasking, so I don't try and do those things when I join a webinar. So thank you for engaging actively. Sam, who said yes. Okay. Thank you very much for your responses. This is a little bit of a trick question because everyone's going to interpret somewhat differently. I think the most correct answer is it depends. So if it depends on largely whether there was wrongful intent or whether we're talking about doing the wrong thing unintentionally, accidentally, and due to oversight, for instance. So if we talk about the wrong thing on a spectrum, the wrong thing might be stealing money and defrauding a not-for-profit organisation of its hard-earned cash. And if you do that, you can absolutely go to jail. And right now, here in Queensland and the ACT, and probably every state and territory of Australia to be realistic, but I know of those two examples, right now there are people in jail for stealing money from not-for-profit organisations. So can you go to jail for doing the wrong thing in terms of stealing money? Absolutely you can. If we go down the other end of the spectrum though, the wrong thing we could also consider to be something like maybe being a little late for our AGM. So if our governing legislation says we've got to have our AGM within 6 months, like it does here in Queensland, or within 5 months, like it does in some other states or territories, or for companies limited by guarantee, and we're a little late having our AGM, are we going to go to jail? No, we're not. So, and I think, Claire, in your response, yes, but unlikely, we're probably down this end of the spectrum. Like realistically, are we going to go to jail for doing some of those insignificant wrong things that represent a breach of our governing legislation? No. In some cases, there might be penalties issuable under our governing legislation, which might lead to some financial penalties, and I'm going to talk you through those for Queensland in just a moment. But the likelihood of us going to jail for doing, the wrong thing willfully and acting in negligence and breaching director duties, sure, it exists, but the reality is that the vast majority of people with whom we deal at CPR Group in a volunteer capacity in the not-for-profit sector, want to do the right thing, and they intend to do the right thing. They set out to do the right thing, and sometimes mistakes happen, and that's okay. Sometimes we make a decision to spend money on something that we expect to have a great return on that investment, and it doesn't return the money, and our organisation's placed into financial distress. Are we going to jail because of that? No, not necessarily. Not if we've acted in accordance with the legal duties of directors. And again, I'll talk through those very shortly because they're pretty universally applicable across the country now. So thank you for your engagement there. I really do appreciate you jumping on the chat and answering that question. And hopefully we're all now on the same page. That, you know, in a very consultant-like way, the answer is it depends. But hopefully I've lent a little bit of context to that discussion as well. So the team and I just did a bit of a brain dump of the legislation and legal requirements that apply to clubs. And as you can see there, the state-based legislation is Queensland focused. So there are some federal pieces of legislation and codes and so on here that relate to all of you as organisations that exist in Australia, for those that are here. For those in New Zealand, the food standards of Australia and New Zealand apply. But you can see that this is by no means an exhaustive list, and we've only focused on Queensland, but the principles and the key takeaways from today's discussion are applicable across the country. So the key things that we are going to focus on are here in bold now. So we're going to talk tax, we're going to talk governing legislation, we're going to talk fundraising, we're going to talk liquor and gaming, we're going to talk child safeguarding, work health and safety. So this is just a nice little broad brush overview, and what we wanted to do was to identify the critical things that are really important for you to be aware of. And even if you're interstate, we're going to talk through the legislation for which there is counterpart legislation in your state, and you'll pretty easily be able to find that respective legislation and go and ask the relevant regulator what you need to do to comply with that legislation. So let's start by talking about your legal structure as a not-for-profit. Most of our not-for-profits here in Australia are incorporated associations, and the reason for that is that it's the easiest legislation to comply with. It's the easiest mechanism to create a new not-for-profit entity. So incorporation legislation is managed at the state and territory level, and I'm going to talk through each of those regulators in just a moment, as well as some of the recent changes that have happened interstate as well as here in Queensland. But we also have other legal structures. So we've got some companies limited by guarantee. So I know we've got a couple of our national sporting organisation representatives online today, and I know that at least some of you are companies limited by guarantee. So you are a company that reports, instead of to a state regulator, you report to ASIC, just like private companies like ours do. And you are established under the Corporations Act. But there are plenty of other legal structures as well. There are Indigenous corporations that report to the Office of the Registrar for Indigenous Corporations, or ORIC. There are university student associations that are established under the respective University Act. There are bodies corporate, there are cooperatives. So there are a wide range of legal structures, but the really important element that is consistent across the board is that regardless of your legal structure, if you're a not-for-profit and you are a legal entity in your own right, and what I mean by that is you don't operate under the auspices of some other legal entity, you don't operate as a branch, for instance, of another legal entity. If you're a legal entity, an organisation in your own right, then you are what's called a body corporate with perpetual succession. Now, that term might sound a little bit legalese, but I'll break it down into two key components. Body corporate means legal entity. You are a group of people that at some stage have come together with a shared common interest, and you've established a legal entity, a body corporate, a group of people, and that entity is seen in the eyes of the law in the same way that a person is seen. So it can own land, lease land, it can have bank accounts in its name, it can trade, it can do activities that any other business or person can do, and it can put the money that it generates by way of revenue into its bank account or bank accounts. It can sue and be sued. Your organisation can do everything that a person can do. That's what body corporate means. Perpetual succession means that the people who are in the decision-making roles at any given time change. So each AGM, you might elect an entirely new group of decision makers as your committee or board or executive, and that group of people are empowered to make decisions for the time that they're in office until the next AGM, when maybe some of them will step away and some new people will step in, or maybe they'll all be re-elected. But at some stage, all of those people who are on your committee today will no longer be on the committee. But the legal entity stays the same. Your incorporated association number or your company, your Australian company number, it stays the same, regardless of who is in the decision-making positions at any given time. So we are a body corporate with perpetual succession. So this brings with it some really significant benefits, and it doesn't cost a lot, particularly if you're an incorporated association. Here in Queensland, it costs you about $180 to get set up. It costs you about $60 a year to report to OFT. In some states and territories, it's free to submit your annual return. In others, it's a little more expensive, but it's not expensive. We're talking, tens or hundreds of dollars to be afforded the legal status that body corporate with perpetual succession status brings with it. So what that body corporate does is it creates a legal entity which is separate from your organisation's members. So if the organisation, as I said earlier, gets sued, then as long as the individual decision makers have acted within the parameters of their authority and they've not breached the legal duties of office bearers, which, as I mentioned earlier, we'll talk through in just a moment, then under ordinary circumstances, they are protected because of this body corporate being a legal entity, having the powers of an individual. So it is separate from the decision makers, and it, as a body corporate, is separate from all of the other members of the organisation. So it's a really valuable benefit or suite of benefits that you get by virtue of your incorporated association or company or other body corporate status that is, like I say, relatively affordable. So to compound or enhance that legal protection for decision makers, some organisations consider taking out directors and officers liability insurance. Now, I'm not an insurance advisor, so I can't tell you what insurance you should consider or take out, but this is a question to ask your broker or advisor. Engage with them and ask, is directors and officers liability insurance something that our organisation should be considering? And if so, what's it going to cost us to take out? Because it can afford some additional protections, including covering the costs of fighting a legal battle if any one or more of your committee members are the subject of a claim. So it can be a consideration. And because you're a legal entity and you've got the powers of an individual, you can enter into an insurance policy with an insurer. So that is the fundamental sort of legal structure overview for your not-for-profit organisation. So here in Queensland, our legislation was enacted first in 1981, and it's been reviewed about 7 times since then, most recently in 2020. And in 2020, our Queensland Parliament agreed to some pretty significant changes to our Associations Incorporation Act, and those changes have taken effect incrementally, with the most recent changes and final changes taking effect in 2024. So all of the changes agreed to by Parliament in 2020 now have taken effect. So the incorporated association legislation in your state or territory may have also been amended in recent years. So in New South Wales, for instance, in 2025, we had some changes to thresholds for reporting in terms of the amount of money that you make and your current assets. The same thing happened here in Queensland, as I'll talk through in just a moment, with the dollars being a little different. But we also in 2022 in New South Wales saw the introduction of a new model constitution and some updated regulatory structure provisions. In Victoria, in 2023, the regulations were amended and that revised some financial reporting thresholds as well. So we're seeing incorporated association legislation come into line with the Corporations Act, which has higher reporting thresholds for organisations in terms of whether we need an audit or a verification from an accountant, or whether our president and treasurer can simply sign a statement saying our financial statements present a true and accurate record as far as we know. The amendments in Victoria in 23 also streamlined annual reporting obligations and updated some fee structures. In South Australia, some minor updates in 2023, modernised references, fee amounts and procedural details for associations. And we also had some changes in 2021 to 22 in South Australia that introduced some minimum member requirements and clarified committee obligations and record keeping. So and in WA right now is being considered by state parliament over there, some potential changes to the associations and cooperatives legislation. So we're seeing that it's pretty regular that governing legislation is amended across the states and territories of Australia. So this is something that's really quite an easy question to ask of your regulator, to pick up the phone. So here in Queensland, the Office of Fair Trading, in New South Wales Fair Trading, Victoria, Consumer Affairs Victoria, in the ACT, we've got Access Canberra, in South Australia, Consumer and Business Services, in Tasmania, Consumer, Building and Occupational Services. In the Northern Territory, it's Business Registries, and in WA, the Department of Mines, Industry Regulation and Safety, Consumer Protection Division. So call your regulator and say, when was our legislation last amended, and was our constitution registered with the current one you've got on file? Was it registered since then, or are we a little out of date? Because that's a really good trigger if your governing legislation has been amended to consider updating your constitution, and we'll talk about that shortly. So if you're a company limited by guarantee, as I mentioned earlier, you report to ASIC, and there have been some recent changes in terms of holding meetings online and signing documents digitally that a lot of old constitutions, as you can imagine, don't provide for. So here in Queensland, some of the key changes then that have taken effect include these, where some breaches the maximum penalties for breaching the Act have been increased significantly. But I just wanted to demonstrate my PowerPoint prowess here by using the highlighter function and point to these duties here. So here in Queensland, our incorporation legislation really lagged behind the rest of the country, and we didn't have enshrined in our Associations Incorporation Act. Yes, it was, I suppose there were some provisions which applied at common law, but we didn't have really clear, explicit mention of the legal duties of office holders in our incorporation legislation. And like I say, every other state and territory has had this for some time. So in Queensland, this change took effect in 2022, the legal duties of committee members came into line with the legal duties of company directors. So if you are a management committee member of an incorporated association here in Queensland, then the legal duties according to which you must abide in your fulfilling your role as a committee member are now essentially the same as they would be if you were a company director. Now, I don't tell you this to frighten you. The reason that I tell you this is to empower you to make the right decisions, because sometimes the right decisions are not going to be the easy decisions. Making the right decision financially to ensure the solvency of your organisation, as you can see here, really probably the most significant change in the whole Associations, Incorporation and Other Legislation Amendment Act passed by Queensland Parliament here in 2020 is this legal duty to prevent insolvent trading. So that means that a management committee must make good financial decisions which ensure or underpin its solvency and ensure that it makes more money than it spends each year. Because I'm no economist, but I reckon that if you break even or lose money for enough years in a row, you're going to run out of money altogether. So solvency means having enough money to pay your bills as and when they fall due. To have that money, you've got to be making more than you spend. It stands to reason. And as many of you know from previous sessions with us here at CPR Group, not-for-profit is very different from no-profit. And not-for-profit simply means that you can't distribute your profits amongst your members as if they were shareholders. But you absolutely can, and indeed now, as enshrined in the legislation, must strive to make a profit every year. So there are also some other requirements here in terms of legal duties, like disclosing material personal interests if you have a material personal interest in a matter that the committee is considering, like paying some business to do some work and you run that business or you own that business, then that's a material personal interest. Some of the more sort of logical or obvious duties, like exercising care and diligence, making decisions that are in the best interest of the organisation, acting in good faith based on the information you've got, you think you're making the right decision, and not improperly using your position or information that you get through your position as a committee member to gain benefit for yourself or someone else. So that's like the insider trading clause. So there were a host of other changes that took effect as well incrementally over the past 4 years or 5 years. However, the important takeaway here is for you to get up to speed with the changes in your state or territory. It's a very easy phone call to your regulator, as I mentioned. So this ties nicely then into this discussion about a committee member's accountability level. And all of your management committee members or your board members or your executive, they share equal accountability. So your treasurer is no more accountable for your financial position than any other committee member. And that's why the treasurer has to present financial statements to the management committee every month. Because if the management committee don't get that report, how can they possibly make informed decisions? How can they exercise care and diligence if they've got no idea whether the organisation has enough money to pay its bills as and when they fall due? They simply can't. So the difference between accountability and responsibility is a bit difficult to define, but the way that we try to do it is by saying you can, as a committee, you can delegate responsibility. You might delegate responsibility to your grant writer for preparing competitive grant applications. You might delegate responsibility to your secretary for managing the club email. You might delegate responsibility to the treasurer to do bookkeeping and for setting up invoice payments for co-authorization by someone else with internet banking details as well. But what the committee can never do is delegate accountability. The committee remains accountable for the decisions of the organisation and its actions. And I suppose that the best way or clearest way for me to articulate that is to point to some of the breaches which are able to be imposed under the Associations Incorporation Act here in Queensland. Now, across states and territories of Australia, the severity of penalties issuable under the respective incorporation legislation differs quite a bit. In some states it's higher, in some states it's lower. But here in Queensland, the maximum penalty issuable under the Associations Incorporation Act now exceeds $9,000. The previous slide talked about the maximum penalties increasing to more than $8,000. The reason for that is that the value of a penalty unit, a state penalty unit here in Queensland, increases over time. So a penalty unit in Queensland is now about $160. So 60 of them is more than $9,000. So it's a serious fine. But in reality, the likelihood of you being issued a fine as a management committee member, if you're guilty of insignificant wrongdoing, as we were discussing earlier on that spectrum, then the likelihood of you actually getting a fine, in my experience, is pretty slim. But the possibility exists. The Office of Fair Trading or the state government can impose fines, penalties, and typically this is only going to follow court proceedings for more significant penalties. However, the reason that I wanted to talk to this is that, as you can see, the vast majority of penalties issuable under the Associations Incorporation Act are not issuable to the organisation, but are issuable to the committee members, the people who make decisions on behalf of the organisation. And that is clear indication that it's the individuals who are accountable for the good decisions and financial stability and compliance of an incorporated association. It's not the body corporate itself, it's actually the organisation. So this is a really important takeaway, and I suggest that if you're here in Queensland, that you have a look at the Associations Incorporation Act. Don't read it from cover to cover unless you're suffering from insomnia. But you just pull up a digital copy of the Act online and search penalty unit. And you'll see all of the instances of where those words appear and the severity of the penalties issuable under the Act, as I mentioned. So under the Associations Incorporation Act, like in other states, we've had some changes to our reporting threshold. So if you're a small incorporated association, you don't even need to give your financials to an accountant anymore. You, as an incorporated association, your president and treasurer can sign a verification statement saying, as I mentioned earlier, yes, our financial statements present a true and accurate record of our financial position. If you're a medium incorporated association, you need to have your books verified. And if you're a large incorporated association, you need to have your financial statements audited. Now, just as a bit of a demonstration of the significance of the change in this regard, in terms of our reporting thresholds, a small incorporated association, which used to be called a level 3 association, both of those thresholds used to be $20,000. So if you had current assets of less than $20,000, and that should actually be "and" there, you had total revenue of less than $150,000, then you didn't need to get your books audited. But now, and your total revenue was less than 20. Now those thresholds have increased, as you can see there, significantly. So current assets is typically cash, money that you actually have in the bank. So if you've got less than 300 grand in the bank and you turn over less than 150 grand a year, you don't even need to give your financial statements to an accountant. Am I, as a governance consultant, going to recommend that you don't give your financial statements to an accountant? You can probably sense from the way that I asked that question that the answer is going to be a resounding no. However, for some organisations that are well below those thresholds and they don't have the financial means to pay an accountant and they can't find one who'll do the verification cheaply for them, they can choose to have an internal verification process only. So that's important for you to know. But you're probably still going to get your books audited or verified, and the person who wants that to happen is probably going to be the treasurer. So, as an incorporated association, you've got to have a constitution, and your constitution should, ideally in our opinion, meet these sort of key principles. It should be compliant. You shouldn't just shelve it once you've written it and never refer to it again until someone wants to get someone else kicked out of the club. It should be simple and flexible, and ideally it should be future-proofed, and it should be reflective not only of legal compliance requirements, but should also be reflective of good business. And when you come to adopt a new constitution, and this is pretty universal across all incorporated association legislation as well as company legislation, if you want to change your constitution, you need to have a special resolution carried. And that is one which is approved by the votes of at least 75% of the people who can vote and who are at your general meeting at which you present that proposed special resolution. So it's not 75% of your members. Make sure you read the underlined bit there, present and entitled to vote, because it's everyone who is there at the meeting. It's not anyone who's not at the meeting. They don't count towards that 75%. It's only the people in attendance. And then we've got to lodge it with our regulatory authority within the required time frame. And our new constitution takes effect either when it's adopted or when our registration of the document is confirmed. So if you are not sure whether your constitution aligns with the legislation as it stands in your state, you can take a note of that QR code and URL there, and you can simply upload your constitution to our webpage and we will take a look at it. We'll let you know if it is compliant or if it falls short. And if it falls short, we'll give you some key pointers that you can use to go and prepare yourself a new constitution. Or if the document is woefully out of date and you don't want to do it yourself, we can absolutely help with that process. We are writing constitutions every single day for incorporated associations across the country, as well as companies, Indigenous corporations, and so on. So we can make that process really, really easy for you. If you decide that you would like a new constitution, you can get in touch with us. But if all you want is for us to look at it, we'll do that at no cost. It's one of the little value adds for you being here today. So the next big one, we're getting into the realm of money now, given that we've talked about reporting thresholds. What about GST? The goods and services tax is a confusing tax, and it's one through which the Australian Taxation Office employs hundreds of thousands of tax collectors throughout the country, and it's all of us. So if your organisation is going to exceed $150,000 in turnover, so note that that's the same as the small incorporated association turnover threshold now. I don't think that is a coincidence. In any 12-month period, then you've got to register for GST. And once you're registered for GST, you've got to charge GST on taxable sales. So that means that you've got to put your fees up by 10%, because otherwise you're giving the ATO your money. So I worked with a club probably about 10, 15 years ago now, and their income had been increasing gradually, and then they became aware that they were going to exceed the $150,000 GST registration threshold, and we connected them with the accountant who was able to support them through the GST registration process. And then when we went back to meet with them a few months later, we said, right, so how's everything going? They said, oh, look, yeah, we couldn't put our fees up by 10% because our members would just leave. They wouldn't be happy with that. So we only put them up by 5%. And we did sort of a similar thing in our canteen. And I was gobsmacked. When I picked my jaw up off the ground, I said, so you're giving your money to the ATO? Yeah, we couldn't possibly ask our members to pay it. So that mindset is fundamentally flawed. If you become a tax collector and you're collecting tax on behalf of the ATO, that is part of doing business, regardless of whether your members want to pay that GST or not. It's not your money. It is money that is going to the ATO. And I suggest that there be a reasonable consultation process with your membership so that they understand the reason for the change. But as soon as you explain that, the only people you're going to lose are probably the people you don't want anyway. So I'll get off my high horse. Once you're registered for GST, you've got to lodge business activity statements or BAS returns. You've got to keep good records of your GST that you're collecting. And you can also claim what's called input tax credits. So if you spend money and you pay out GST, you can claim that GST back. So the crazy thing about the GST system is that if you're a GST registered entity, your net position shouldn't change because of GST registration. So all of the money that you spend by way of GST and all of the money that you collect by way of GST should mean that your net position doesn't change. All that you're doing is giving the ATO any GST that you've collected. But then if you've paid out more GST than you've collected and given to the ATO, you can claim the input tax credit. It is a crazy system. And several federal politicians died slow and painful deaths on national television in the lead up to the rollout in the late 90s. John Hewson, I'm looking at you. Some of you will recall that interview, no doubt. So nevertheless, as crazy as the system is, it's our goods and services tax. So we live in that environment and we've got to do the right thing. So let's stick with tax, income tax exemption. This is a change. The GST system's been around for 25 years. The income tax assessment or tax ruling from 2022 means that there's now reporting required. So in October last year, your not-for-profit organisation, unless if you're a charity, in which case you can not listen for a few moments, because if you're a charity, you simply have income tax exemption by virtue of your charitable status. But if you're not a charity and you are not-for-profit, then you, for the last year or so, have had to report to the ATO. Now, the way that reporting happens depends on the nature of your organisation. So if you're a not-for-profit entity and you're physically present in Australia, which you all are, and your income and expenditure relates primarily to the objects in your constitution, and you fall within one of 8 categories, one of which is sport, then you can self-assess as income tax exempt. Now, that's always been the case. You've always had to do this self-assessment, but you've never had to report to the ATO until October last year. What does that mean? It means no one ever did it. So we think that this is new, but it's actually not. The only thing that's new is that we need to report our income tax exemption eligibility status to the ATO. And if you don't, you can get in trouble. But the actual process is easy. The problem, the difficulty, the challenge that most organisations are now experiencing is connecting the organisation with the person who can submit those self-assessments on its behalf. Because a lot of these organisations have never been in the tax system. The ATO might have someone on file, and that person might have been around years and years ago. It might have been an old secretary, might have been an old treasurer or president, but we got no idea who it is, and they're not going to tell you. So some organisations have worked around this by simply submitting some meeting minutes to the ATO to say this person here is the current treasurer, secretary or president, and they can deal with you on our behalf. So you can give some consideration to that, or you might just need to contact the ATO and ask them how to connect a person to your organisation. And thank you, Margaret. Yes, the most difficult thing can be actually finding the form. You're exactly right. It's a real challenge, but the ATO are there to help, and if you call them and you struggle to get their assistance, then the likelihood that they're going to get you in a whole lot of trouble, I suggest, might be somewhat limited. But if you don't fall in one of those categories, then you might be able to lodge a tax return based on the mutuality principle, which means the money that your organisation makes from its membership and the benefits from which filter out to the organisation's members, that money is generated and raised, the revenue is raised for the mutual benefit of our members, then you might be able to submit a tax return under the mutuality principle. But where you're making money from external sources, for instance, fundraising or a sausage sizzle at your local hardware store, for instance, Hammer Barn for our Bluey fans, then you might need to pay tax on that. And that is, again, no change from how it's always been. But because we have new reporting requirements to the ATO from not-for-profits, organisations that have always slipped through the cracks are now getting picked up here. So this is certainly a legal requirement that your organisation should have already been navigating over the past 12 or 13 months. If you haven't, it's time to get onto the ATO and ask the direct question of how you can get compliant with that requirement. Okay, this is another black swan. This is another one of those things that a lot of people do not know about. So again, two pieces of legislation which relate to fundraising here in Queensland are the Charitable and Non-Profit Gaming Act and the Collections Act. So the Charitable and Non-Profit Gaming Act relates to category 1, 2, 3 and 4 games. And if you run, and typically organisations are running categories 1 and 2 games. So these are raffles. The gaming legislation, or Charitable and Non-Profit Gaming Act rather, calls them art unions, but an art union is a raffle. And bingo is in there as well. But what you need to know is that if you're running any raffles, you need to keep certain records, and that's records showing things like ticket sales and prize values and how the proceeds have been used. And those records must be kept for at least 5 years after the end of the game. So very few organisations keep these records. But if something goes wrong and someone makes a complaint about how your organisation conducts a raffle because they think it feels a little bit wrong, and even if they don't understand the requirements for category 1, 2, 3 or 4 games, they might make a complaint to the Office of Liquor and Gaming Regulation. And under the Act, the Office of Liquor and Gaming Regulation, or OLGR, are obligated to investigate. And if they find that you're not doing the right thing in terms of your record keeping requirements, then you can get in quite a bit of trouble. So, Charitable and Non-Profit Gaming Act. If you want to know more, simply Google Category 1 Games Queensland or Category 2 Games Queensland. And you'll get a really useful workbook or information booklet rather, and it breaks it down and makes the record keeping requirements really easy to understand. The other one that I mentioned is the Collections Act. So this is a really old piece of legislation from 1966, and in Queensland, fundraising means requesting donations or otherwise doing appeals for financial support from the community. And if it's for a community purpose, then you might need to apply to the Office of Fair Trading for a license, for a fundraising license. Now, if you're just generating funds for your internal purposes as an organisation, then you might not need a license, but guess what I'm going to suggest you do? call the Office of Fair Trading and ask them. Explain to them the nature of the fundraising activities that you conduct and ask the direct question, do we need a licence under the Collections Act? And they will answer your question. You might need to go through a few people before you get the clear answer, but ask them the direct question and make sure that you're keeping the appropriate records and that you're only conducting fundraising activities that you are actually allowed to conduct. This might not apply to all of you, but if you sell alcohol, do it right. Don't have an esky in the storage shed with an honesty box where you sell a few cans after training, or you try and fly under the radar of liquor licensing. I worked with a squash club that had no liquor license, and of which I know there are 3 members who are police officers. And of course, they didn't know that the club didn't have a liquor license, and they would have a beer after a game of squash. But this is not okay, because there are some serious fines issuable if you're selling alcohol without a license to do so. But that's one consideration. But if something goes wrong, if something goes wrong and someone gets injured or property gets damaged and you don't have a license to sell alcohol and you've done so, that's when things can get seriously scary. So make sure that if you're selling alcohol, you do it right. There are some really important considerations like responsible service of alcohol, and these requirements exist to keep people safe, to make sure that people who go to have a drink at a licensed venue for a good time are able to do so in a safe environment. We also have gaming legislation. The Office of Liquor and Gaming Regulation here in Queensland are the ones who administer our liquor and gaming regulation, as their name suggests. No prizes for guessing what they do. And again, we've got responsible service of gambling requirements, and if your club is one which has gaming machines, then you'll be right across this, and you know the importance of adhering to these legal requirements. The next place I want to go is to talk about paying people. And again, similar to selling alcohol and only doing it right, we advocate very strongly that if you're going to pay people, if you're at the point as an organisation where you've realised, look, we can't get volunteers to do all of the stuff that needs to be done, and we've completed a bit of a financial assessment, and we've determined that we can afford to pay some people to get some stuff done. If you're going to do that, make sure that you follow due process. Make sure that maybe you get the right help, and you might go to a labour hire company. You might get support from an HR lawyer, but it's really important that you don't try to pay people under the table. And this is often what happens in smaller not-for-profit organisations. There's this sort of snowball effect where, one person might get paid a little bit of money to do a little job, and because it's a bit difficult to account for it, they're doing some work in the canteen. We tell them, look, just take $10 an hour and just take it out of the till before you tally the till for the day. And then that grows from there. And because we've commenced paying people in an unorthodox and non-compliant way, it can grow into a situation that we saw a gymnastics club in, where they had several coaches. So gymnastics is a sport where there's quite a bit of professionalism in its delivery model. And we have coaches who in some cases might come here from overseas. It's very hard to get good coaches in gymnastics. And they might be brought here, they might be here on visa, and they might be doing some legitimate work, for instance, working in a restaurant, and they might also then be doing some work at a gymnastics club. But these individuals, these coaches were actually residents. So they were Australians, locals, and they were being paid, but they were being paid cash, and it was off the record. There was a wages and salaries line item in their financials, and the accountant had started to ask some questions about that, but he was still happy to provide a qualified audit. And it was all well and good until COVID hit. Now, this is an entirely, well, depending on who you ask, an entirely unpredictable impact on the club. And as those of you who were in an employment position at the time of COVID will recall we had a little initiative called JobKeeper. And if you had been in employment for the 12 months preceding COVID and the government mandated shutdowns, then you were eligible, or your employer was eligible for JobKeeper, and they could keep you on or they could stand you down and you could continue to receive federal government payments. But if you were getting paid cash as a gymnastics coach and there was no evidence other than an ambiguous wages and salaries line item in the financial statements of you receiving payment as an employee, guess how much money you got through JobKeeper? $0. So it's all well and good until it's not all well and good. And whether it's an inability to capitalise on federal government support payments during a global pandemic, or whether it's someone in an employment position getting disgruntled and having someone in their ear, maybe a good HR lawyer, saying, hey, do you know, Steve, you've been doing work for that club for 10 years and they've been paying you cash or they've been paying you as a contractor. Do you know that they should actually have been employing you and you should have been entitled to sick leave and annual leave and super, and you haven't been getting paid any of that stuff. And it's fine if you still love the organisation and you're happy, but if you're not happy, that little birdie in your ear might cause you to take some action that is catastrophic for the organisation, like to the point of the organisation having to declare insolvency. And unpaid super, let me tell you, is something that you do not want on your name. So if you're going to pay people, just do it right from the outset. There are some instances where you might be able to pay people through the ATO statement by a supplier form, which is like how we pay our sporting referees, for instance, or umpires. They're kind of volunteering, but they're getting a bit of money. They're doing it as a hobby, and whether they declare it as taxable income is up to them on their tax return. But we have had them give us a statement by a supplier form, which is essentially like a contractor form, but they're giving us the form telling us why they're not stating an ABN. And for many positions, though, that doesn't suit. And you may need to consider a contractor, for instance, and some functions like bookkeeping are ideally suited to contractors. But as I mentioned, don't pay someone as a contractor if they should actually be an employee. So you might actually be better placed having people in part-time or casual employment. But again, take the right advice. And if you have one paid employee, then the Work Health and Safety Act applies to every one of your workers, including your volunteers. So that's really important to know, because the Work Health and Safety Act places on your organisation some statutory compliance requirements to meet health and safety provisions. Now, we say if it doesn't apply, act as if it did. You want to keep your workers, volunteers or otherwise safe. But you need to know that if you've got at least one paid person, that act applies to everybody. Okay, let's now finish by talking about child safeguarding. Now, we've talked a bit about money, we've talked a bit about governance and compliance, and I love supporting not-for-profit businesses to become more successful not-for-profit businesses. But I make no bones about the fact that there is not one thing that your organisation will do that is more important than ensuring that no child or young person comes to harm while they're in your care. This might not apply to your organisation. If you are a university of the third age and you only provide services to people in the third age of their life, then the likelihood that any of them are going to be under 18 is pretty slim. So this might not apply to you. But I'm going to talk about it because for all of your benefits, it's important that you know that we are in a really interesting period of change when it comes to child safeguarding legislation. So again, focusing here on Queensland, we've got blue card legislation and we've got a new Child Safe Organisations Act. So our blue card legislation has recently changed and blue card system requirements are a little different, and I'll show you those in just a moment. But we've also got this Child Safe Organisations Act. Now, there is counterpart legislation to both of these across the country. We've got blue cards in various states. In the Northern Territory, they're called an ochre card. The Working with Children system, the check system, is pretty good at picking up people who've done the wrong thing and been caught doing it. But of course, we know that a lot of people who have done the wrong thing just haven't been caught. So in addition to blue cards, your organisation has historically here in Queensland needed to have a child and youth risk management strategy. That's being phased out, and you will instead need to comply. You'll still need to have blue cards for all people providing regulated services to kids, but you'll also need to comply with the Child Safe Organisations Act. And that is focused on your organisation meeting the 10 national principles for child safe organisations. So there's a new national standard, but there's state legislation that guides compliance in each state and territory with that set of 10 national standards. And I'll tell you what they are in just a moment. I'll show you a little flyer in just a moment. But if you're here in Queensland, you need to know that blue card legislation has been recently amended. So blue card services have been doing a bit of a roadshow in person and online to talk through these changes, as has the Queensland Family and Child Commission regarding the Child Safe Organisations Act. So there's a lot happening in the child safeguarding space, and rightly so, because I think that there are still some pretty significant shortcomings in the system. And none of this takes away the need for an organisation to exercise diligence and care in making sure that it is living and breathing a child safe organisation philosophy, rather than just having a strategy here and doing some blue card checks there and thinking that ticking those boxes makes it all okay, because it doesn't. If we're not living it and breathing it, then we're not doing everything we should be to keep kids in our service delivery environment safe. So I'm not going to talk through those in detail, but again, like I say, you can come back to these slides in the recording, and you can do your own research. You can just Google Queensland Blue Card System changes. It'll take you to Blue Card Services website, where it provides a lot more detail on this stuff. And I think there are some really good changes, like no card, no start laws. Until you've got your card, you can't start in regulated employment. And access, broader access to things like domestic violence orders and convictions for blue card assessments. So some really good changes there. Finally then, here are the 10 national principles for child safe organisations. And I think that while some of these look a little bit kind of duplicative, the system is very good, and the requirements for your organisation to have things like a child safe strategy, a child safe commitment statement, a child safe complaint handling policy, a child safe code of conduct. These are requirements here in Queensland under the Queensland Family and Child Commission administration of the Child Safe Organisations Act, which guide your organisation towards complying with these 10 national principles for child safe organisations. So if you've got questions, get onto Blue Card Services or get onto the Queensland Family and Child Commission, and they will be able to answer those questions. And like I say, to leave you with this thought, there is nothing that you'll do that's more important than not just ticking the box of saying, yes, we're a child safe organisation because we've got a child safe strategy, but actually reviewing that document, pulling it out at your committee meetings, making sure that every new coach, if you're a sporting organisation, gets a copy of that document, and so on. Okay, so this is now an opportunity for me to leave you with the sort of key takeaways. You like my little takeaway box over there? I thought you would. That we've talked through today. So know your governing legislation, regardless of whether you're incorporated, a company, or some other body corporate. Be familiar with the legislation under which you're established as a legal entity and any changes that may have taken effect to that legislation in recent times. Be familiar with your tax obligations. If you turn over more than 150 grand a year, you've got to be registered for GST. If you're a not-for-profit and not a charity, then you've got to engage with the ATO to determine whether you are income tax exempt or whether you need to submit a tax return, and whether you might be able to capitalise on the mutuality principle for at least some of your income. Run compliant fundraising activities. I probably should have put this one in red or something, because it's the one that often flies under the radar. The ATO doesn't send you a letter and a series of reminders if you don't comply with this one, but they'll send you that for the income tax exemption reporting requirement stuff. So you've got to exercise diligence as a committee member in ensuring that you're compliant in your fundraising activities, keeping appropriate records if you're running raffles, and asking the Office of Fair Trading here in Queensland, if this is where you live, about whether you might need a fundraising licence if you're generating funds out there in the public. If you sell alcohol or you've got gaming machines, it really goes without saying, but I say it anyway, make sure you're doing the right thing according to that legislation. Make sure you're keeping people safe. So if you've got any employees, and even if you don't, if you're all volunteers, make sure that you're applying good work health and safety practices. And if you do need to comply with work health and safety legislation, that you're doing so. And finally, keep kids safe when they're in your care. Parents of kids who participate in your activities, if you do have junior participants, entrust you with the most precious thing in their life, and they expect you to uphold the greatest standards of care for those children as if they were your own. So making sure you comply with the legislation is one thing, but ensuring that kids are genuinely safe while you're entrusted with them, that's the most important thing. That brings us to the end of our 2025 webinar series for CPR Group. I cannot believe that I am saying that. That is a really scary concept, being whatever it is, 5 weeks till Christmas or something absurd. If you're a podcasty type person, head over to Basket Case Clubs, give us a listen there. I promise you, you will gain value, you'll gain insights, and you might even have a bit of a laugh at Michael and I talking about all things Basket Case Clubs, but also sharing tips and tricks and insights from clubs that have gone from being basket cases to becoming showcase clubs. And if you've enjoyed the webinar series today and all the other sessions that I know some of you have participated in, scan that QR code down the bottom right of your screen there, head over to Google and give us a 5-star review. Our marketing team would be eternally grateful, and I'll even get some brownie points too, which is always a win for me. So thank you all once again for the awesome work that you do across the sport community and not-for-profit sector here in Australia. For those of you who we work with directly, thank you for the opportunity to do so. For those of you who don't, we're here and we're always happy to answer questions. We're real people. You can head to our website, cprgroup.com.au/contact. It'll give you a 1-800 number, or you can fill in a form and that'll go to our customer success lead, Adrian, and he will connect you with one of our consultants. We are really, genuinely committed and passionate about supporting all the people like you across the country who do the wonderful work that you do. So thank you for that. And I look forward to seeing you online for our webinar series next year. I don't know what's in store. I don't know what we're going to do next year. We've got a meeting in a couple of weeks' time before we break up for Christmas to have that planning discussion for what the webinar series is going to look like. But if you've got any suggestions, please get in touch. If there's anything else that you would like to know more about, shoot us an email at our contact form, or get onto us on socials there. Any of those handles will connect you with us, and we'll be really happy to address the things that you're most interested in hearing about. So without further ado, thank you. If I don't connect with some of you, which I'm sure I won't before the end of the year, have a very safe and happy Christmas and New Year, and I look forward to seeing you again in 2026. Thanks very much. Have a lovely day.
Basket Case Clubs acknowledges the traditional custodians of the country on which we record, being Yugambeh, Turrbal, Jagera and Kabi Kabi land. We recognise their enduring connection to land, waters and culture, and pay our respects to elders past, present and emerging, and extend that respect to First Nations listeners.